Good morning, everyone. It is the appointed hour. We'll convene the October 13th meeting of the Oklahoma City Employee Retirement System Board of Trustees. Item number 2 on our agenda is to approve the minutes of the meeting of September 8th, 2016. A motion and a second. All in favor? Aye. All opposed? Motion carries. Item 3 is the consent docket. We have one item. Have a motion and a second. All in favor? All opposed? Motion carries. Item 4 is to ratify approvals. We have 3 items. Second. Any questions? All in favor? All opposed? Motion carries. Item 5 is to approve the claims docket. A motion and a second. All in favor? All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. We have 5 cases this month. Motion and a second. All in favor? All opposed? Motion carries. Item 7 is to, did I skip one? No? Okay. I'm getting ahead of myself. Item 7 is to receive the report of death, authorize the payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. We have 2 cases this month. We have a motion and a second. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death, authorize the payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 1 case. Second. Motion is second. All in favor? All opposed? Motion carries. Item 9. This is the same item that we discussed last month. We have item A, to receive a presentation from Brian Ashley or his representative concerning his application for a disability not in the line of duty allowance as permitted under the disability allowance provisions. And item B, we could enter into executive session with the municipal counselor to discuss said application, and or item C, we can consider for approval the following application of disability not in the line of duty. This was deferred again from last month's meeting on September 8th, 2016.
Wiley's not here, but if you would like your questions answered from last month, I'll be glad to answer those in executive session.
That's the pleasure of the board. Have a motion to go to executive session. Okay, we will go to executive session. Do we have to vote? Okay, yeah, we need a roll call vote on that.
Jacqueline Ames? Okay, yes or yea or nay? Yes. Okay, Regina Story? Okay, Craig Freeman? Yes. Carla Nickel? Yes. Jamie O'Leary? Yes. Randy Thurman? Yes. Jim Williamson? Yes. Diana Berry? Yes. King Culver? Yes.
Yes. We will be back.
back to executive.
I come back. They said something about your name. Said they said something about you. I'm sure what they were saying.
Ideally, we would do it the first of the month, just for performance purposes.
Usually takes us a little while to new account set up, and we want to start paying for it after we approve it today. And after that,
Do you want to wait to?
no, no problem. Then we want to start contacting you today. So we know. They're still our testing.
Right.
We know that. So.
So do you want to set up an account for, I guess you have to. Nothing, so you have all your commingled funds, each have their own separate account, is that right? Since we left it in your cash, just left it in your cash. Right, so you don't have to open one up, and you have the account there, it's a line item, we can pull it out.
Okay, we have returned from executive session, and we will consider a motion on item 9C, consider for approval the following application of disability not in the line of duty.
Move for approval.
Have a motion and a second on item 9C. All in favor? All opposed? Motion carries. Item 10, we have two items for individual consideration. Item A is to execute the Wells Capital Management Investment Management Agreement, ERISA Custody Agreement, ERISA Waiver, Qualified Institutional Buyer Form, and the U.S. Investors Qualification Questionnaire.
Just to remind everyone, it sounds like it's for custody, but this is for the emerging markets manager, the Wells Berkeley Street Emerging Markets Fund. And that's just the name of the documents that you have to execute.
Okay. So we'll consider a motion on item 10A.
Yeah.
Oh,
I wanted to throw
I'm sorry.
if you read the documents, they're kind of confusing. The rate schedule and everything, it's their generic documents, but we do have a specific rate fee that they'll be charging that's different than what is in those schedules. And then they're also supposed to take out the indemnity clause. I've spoke with their lawyer, their legal counsel, and they'll be removing that clause from the final documents that'll be executed.
Okay. Thanks, Wiley. So I need a motion on item 10A. Have a motion and a second. All in favor? All opposed? Motion carries. Item 10B is to receive a report regarding responses to requests for information for custody bank services. I won't read the whole thing. Jason, you want to give us an update on that?
Yes. So you do have a little bit of analysis there in front of you. I'm just going to go back and refresh the board's memory. J.P. Morgan has been your custodian for a number of years. You're on what is called the legacy SCI platform. They're transitioning all their clients to what's called the Titan platform. As such, we were in the process of negotiating new fee schedules and whatnot, and as we got further along in that process, through discussions with staff, we felt that this was an opportune time to look at other vendors. J.P. Morgan service issues on your end have been challenging, I think, to say the least. I don't want to necessarily speak for the staff, but certainly in our experience, we have seen the quality and level of service on the custody side from J.P. Morgan slipping. So we issued a request for information to other candidate firms a few months ago. There's really a much smaller opportunity set in this space today, really, if you're thinking about the big custodians for institutional accounts. So we sent a request for information to Northern Trust, Bank of New York, Mellon, Comerica, and State Street, and also included J.P. Morgan in the analysis. And those are really the big players in this space. State Street declined to participate. They're really only looking at bigger clients, and Boney Mellon did participate, and generally they're focused on larger clients as well. So we did an analysis that you see the scoring, and the scoring system is really based on our experience, our operations team's experience working with these custodians, as well as client experiences across the board. Northern Trust really stands out in terms of quality of client service, systems, a number of other factors that we've seen. They're really the Cadillac in the space, if you will. Part of the process was to invite two of the firms, Northern Trust and Comerica, in to meet with staff. Actually, that was done yesterday to Patty Karolzak from my office and Beth Sanborn, along with the whole staff here, and I think others, maybe from accounting, met with the two firms. They presented their platforms along with a number of reports. One of the challenges that we've run into the last several years is some of the GASB reporting, and so that was a big focus on what the banks could provide. I think in the end, you'll see the summary cost analysis on page 10. While Comerica comes in from a dollar standpoint, I suppose substantially less, but than the Northern Trust, it's about all in a difference of about $50,000. In terms of percentage of assets, we're talking less than a half a basis point. And as we look at it, and I think that it came across to the staff, the quality of the systems, the client service, the reporting from Northern Trust is really just head and shoulders above, and so our recommendation would be to go with Northern Trust as a new custodian, or to at least direct staff to negotiate an agreement with Northern Trust for custody. The intention would be to transition after the first year.
So just out of curiosity, not that it changes anything on this, but how does this compare to the fees that we're currently paying?
Well, so we have the J.P. Morgan. There's a lot of estimates that go into this because some of it is transaction-based on accounts that have separate accounts that incur transactions. But you can see it's actually a little bit less, potentially.
The fee schedule listed here for J.P. Morgan is their new fee schedule that we would have to go to once we change to the Titan program.
So basically, we didn't look at them in this process.
Oh, we did.
So we're still
did.
considering them in this process, looking at the new fee structure.
Looking at the new fee structure.
But we were looking with the understanding that we're looking to make a change.
The reason we looked is because of the service issues we were having and the fee issues we were having on the billing where they were
Okay.
overcharging, and that type of thing brought the instance that we maybe should start looking at a new
So
custodian.
what I'm looking at here isn't what we're paying now.
What we're currently
It's-
paying now is about $35,000 a quarter, but we will not be subject to that fee schedule once we move to the Titan program. We would have to be on the $164,000 a year fee, or $138 total for custody.
Okay.
The fees were going up, and that's another reason we started looking, because they were going to be increasing their fees once we moved to the Titan platform.
Okay.
We were going to be required to move to the Titan platform.
Okay, great, thanks.
We have seen a steady decline. I mean, just to put it in perspective, we've really struggled with J.P. Morgan the last several years, not just here, but in other places. Their consultant relations person on the custody and banking side was in our office, and he's really tried to help justify things. But he indicated to us as a business, you know, they're looking at $2 billion and up is really their sweet spot, and $250,000 minimum fees. And we said, well, you know, our clients, not even speaking specifically about Oklahoma City, but our clients really don't fit into that. Most of our clients are in your neighborhood in terms of size. And so we felt that that was also just an indication of them telling us this isn't really the market we're going after. And we think that's been reflected in the experience of the client service people that have been assigned to some of these accounts. They're just, it just hasn't been good. So we're very confident in Northern Trust. We think it's a big upgrade. I think from an accounting and reporting standpoint, it will really improve things, and certainly from just a system side, they're top notch.
Jason, I have a question. I'm looking at 5 different sets of fees at the bottom, estimated annual fee, but there are only 4 firms.
Northern Trust has 2 separate fee schedules, depending on whether we use a flat fee
Okay.
or a transaction-based fee.
Okay, got it. Thank you.
Any questions?
So our action that we're requesting today is to negotiate with Northern Trust for the recommendation of the three.
Correct.
Direct staff to negotiate an agreement with Northern Trust.
I move what Jason just said.
Okay, we have a motion and a second on item 10B. All in favor? Aye. All opposed? Motion carries. Item 11 is investment consultant report.
So you have the September monthly flash report in front of you. So it's turned out to be a very good quarter. One-year numbers, the difference between June and September is very dramatic if you're looking at trailing 1, 3, or 5-year numbers. You're taking off a very bad month. The third quarter of last year, the quarter ending September, and the month of September were a very bad month last year. So you take that off and you have a good month of September this year, and it really changes what you're looking at. I think if we're at the end of June, one-year returns were probably in the 1% range, maybe even negative, depending on what your asset allocation looked like. Now you roll forward a quarter, and the one-year returns are north of 8%. For the total portfolio. So on an absolute basis, doing very well. Relative, we've talked a bit about this, it continues to be pretty challenging for active managers, as we've had pretty significant risk on and risk off trades throughout the year, and that's been a pretty big hurdle for active management. And you see within your portfolio, while the total fund is up 8.7%, gross of fees, a little over 8% net of fees. The policy index is up 10.4%. So markets are up a little bit more. Active management has pulled you back a little bit. The areas that are the most active, which hedge funds, private equity, not looking anything like what we're benchmarking that against in the policy index. That's been a bit of a headwind. Is much more conservative as the markets have rebounded. Also a little bit within large cap, you see your large cap is up 13.5% versus the S&P up 15.4. You're mostly passive there, but with the Intech strategy as a benchmark risk control, that's trailed a bit over the last few months. Longer term, it's done well. As the larger cap names have done a little bit better, they have a little bit more exposure to the smaller names within the large cap index. On the small cap side, we've seen a turnaround from what we were seeing a year ago, where growth was outperforming value, and value is really getting beat up, to where now year-to-date value has really turned around and is outperforming growth by quite a bit. So Earnest has done a good job. Times Square has, while generating good positive returns, they have lagged the Russell 2500 and the growth benchmark. Some of that, a consistent familiar theme, a little bit higher quality, in their portfolio. They've avoided some of the biotech that tend to be a binary outcome where waiting for a drug to get approved. If it's approved, the stock goes way up. That really rebounded in the quarter, and they had limited exposure there, and that hurt them a bit. International portfolio, while the same is true in international markets where value is coming around and outperforming growth more recently, your managers, and particularly Harding Loevner, has done a great job coming out, which is more of a growth-oriented strategy, significant outperformance relative to the benchmark there. On the EM side, a little bit of a lag. Some of that is actually Von Tobel, as the markets there, emerging markets, started to rebound a little bit before developed markets and U.S. markets. Von Tobel, a little bit more conservative in nature, didn't pick up all of the return that the benchmark did, although still doing very well. The new manager that you're hiring, Wells, while you haven't participated in this because you're just going to be funding them in the near future, they've had a very good year. They're actually well ahead of, they're up over 20% on a one-year basis. Fixed income, the fixed income overall up 7%, really led by the Core Plus in Western and the non-dollar Brandywine, the global bonds. Global bonds have really done well, as you've started to see that the currency impact that was a headwind in 2015 has been a positive this year, as some of the currencies that they're in have appreciated relative to the dollar, and that's worked out well. So the Brandywine portfolio is actually up 11.6% on a trailing 1 year. The World Government Bond Index is up 9.7, but really what we're comparing all of your bonds to is the U.S. investment grade market, which is up 5% on the year, so really getting some benefits there. And we think going forward, I think we've been talking about potentially rising rates for a long time. At some point, whether rates stay low or begin to rise, having the diversification in your bond portfolio, including the low volatility hedge funds, is going to be a positive on a relative basis. Even what we've seen the last year, really moving into the end of 2015 and the first couple quarters this year with declining interest rates, Treasury prices going up, but that's not yield. It's just bond prices going up as yields have come down. That's not sustainable. It's a very rich trade, very expensive. Treasuries trading very expensively, and your portfolio is positioned really differently than that. You don't have a lot of interest rate sensitivity in your fixed income portfolio. And then finally, the real estate continues to do well. That had been one of the better performing asset classes over the last year. Now real assets on a one-year basis up 4.3%. Being dragged down a bit by commodities, but the real estate, the Morgan Stanley Prime Property Fund, up a little over 8%, and the opportunistic real estate, which is TA, is up over 8% on a one-year basis. That's coming in. We go back a couple of quarters. At the end of June, real estate was up north of 10% when equities were flat and bonds were up about 3 or 4%. So good quarter. I think your fiscal year is December, right? You do a calendar year. For plans that have a June fiscal year is going to look very different than a September or December fiscal year. It's all the measurement point, but I think it's important to keep in mind that you're looking longer term, and returns are up above your hurdle rate, at least at the moment, over that trailing 1 year period, and really over a 5-year period as well. The total fund is up 10% annualized over the last 5 years, so it's been a pretty good 5 years relative to goals.
Anyone have any questions for Jason?
Thank you all.
Thank you. Item number 12 is comments from board, staff, and citizens.
I have one. back a few years ago, when we became underfunded, we had changed the city ordinance to make the COLA maxed out at 2% only. And I'm thinking, you know, with the insurance rates going up for the retirees, we'd said at the time that once we became fully funded, we could revisit it. And I was wondering if there was, you know, possible to do that now.
Anything's possible to look at, but we have given the full amount of COLA ever since. So the reason to extend the COLA past 2%, we haven't had a reason to do that, only because the actual CPI has always been under 2%. And given the amount, the cost of the COLA, we're not funded enough to do it. I mean, that's a very significant portion of our benefit cost are the COLA increases that I don't think will, if we increase the COLA, depending on what amount you increased it to, we would be underfunded at that point in time as soon as we enacted that.
Well, and our decision to max out the COLA or put a ceiling on it was part of the reason that we are
Correct. Were funded level.
overfunded at 104%. That
Right.
immediately had an immediate.
And truly, that's not a true overfunded position. We're just barely at the funded level. I mean, at 104, whether we're at 104 in a few months is probably not going to be. Given the actuarial calculations, we may be under 104. So, I mean, we're just barely at the point of break even at this point.
Anybody else have any questions? Okay, we are adjourned at 10:28. Thank you.